Time now for top picks from Christine Poole. Number one on this day, McDonald's, MCD in New York.
Yeah, so this is a name that we've had on our watch list for a while, and it's pulled back, and it's actually down about 15% year to date. So we finally added it to our client portfolios about a week and a half ago, kind of like sub $2.50, around the $2.45 level. Everyone knows McDonald's, global quick serve restaurant chain, operating in 100 countries, 41,000 units. 94% is franchise, so very profitable business model. Their franchisees pay them a royalty fee, which is a percentage of the top line sales. And as well, I'm not sure if a lot of viewers know this, that McDonald's actually owns a lot of the land and the buildings that the franchisees are there, like where the stores are located. So the franchisees actually pay McDonald's a rent as well. And rent actually accounts for about 39% of its total revenue. So that's also a very profitable income stream. So that whole franchise model with the rent means that their cash flows are quite defensible, very visible. Obviously, you still want the franchisee to do well over the long term. But those are, I think the rent aspect, the land and building ownership is a bit unique among the other quick serve restaurant chains. The past year, I think that sector has kind of underperformed or lagged concerns of, especially in the lower income households. They're, feel they're high rising unemployment, no more savings to rely on, so it's been softer, more price conscious. A lot of these restaurants raised prices when inflation spiked. So there's a renewed focus on value, and I think McDonald's is definitely one of the players that can do that given its scale and what it's really known for. So we like it. The yield's about 2.7%. They've increased their dividend for 45 consecutive years. So I think this is an attractive entry point.
Okay, McDonald's is number one. Number two, Pembina Pipeline, PPL, on the TSX.
Yeah, so this is the one of the pipeline investments I've referred to, energy infrastructure name. We've held this name for many years, actually. We like it as a core income name, gives you a yield in excess of 5%. Once again, track record of increasing that dividend. Very uniquely placed in Western Canada in terms of their facilities and pipelines to benefit from rising natural gas production. The company at its investor day in May guided to 4 to 6% EBITDA growth through 2026. So they have the projects and backlog in place to support that. It's going to be self-funded, which is good. And we think given that growth rate, that also implies that the dividend can also grow probably at the mid-single digit range, which we like. So they will go organically as well as buy. More recently, they bought the other half of Alliance Pipeline and Osable from Enbridge. And as well, much recently, I think last week they announced the Cedar LNG project, which is based out of BC, which is going to come on stream in 2028. But they definitely will benefit from just kind of increased LNG export facility as takeaway capacity increases. And so, once again, core income name, and we'll be buying it here.
Are declining interest rates a factor here?
Well, declining interest rates will definitely be a nice tailwind for this sector, yeah.
Okay, and the final top pick on this day, RTX Corporation, the company formerly known as Raytheon. It is an aerospace and defense sector company. That's
right, Paul. So the commercial aerospace, we like in terms of just global travel over the long term. Now, for RTX in particular, about a year ago, they discovered impurities in their metals used in manufacturing some components in their engines. So these were engines made pre-2021. But what this caused was they had to bring the engines in for service, inspection, and replacement for these components. So the company sized the impact of this fleet management program in September. They took the charge. So far, it looks like it's on schedule. The parameters they assumed that the costs they would incur have not increased, so that's good. And then finally, on their aftermarket, on their engine side as well as Collins, which supplies a lot of parts to the airplanes, such as landing gear, avionics, interiors. They have a very large install base, so after a period of time, they have to be resurfaced. And so that aftermarket revenue stream is very profitable. And on the defense side, like you said, with all the geopolitical uncertainties, it's I guess, experienced strong growth. Order backlog is actually at historical highs for this company. And so we think that both those sectors will do long term. And there's probably a bit of a valuation catch up once this fleet management program gets behind them.
Welcome back to Market Call. We've had a bit of an adventure here in the studio newsroom. We had a brief power outage. Everything went black for about 20 seconds or so, but we're back up and running. Thanks a great deal to our control room team and technical team who got us back up and running. We're going to go now to top picks from our guest Gordon Reid on Market Call today. And number one, Gordon, is Amazon, AMZN.
Yes, and this is a company that we own in our U.S. large cap portfolio on behalf of clients, Paul. They have had their bumps, and one of them was coming off the pandemic. They saw just an amazing demand for e-commerce, for online shopping. They built out, and in fact, in retrospect, overbuilt fulfillment centers all across North America, made huge investments, and then of course we started to see that online spike plateau and fall a little bit. So they were left with underutilized assets, and it affected their financials understandably. They've now grown into that. And what we're getting as consumers is almost before you can hit the send me button, it arrives at the door. So a great product, they're making money at it. The e-commerce side of their business is doing extremely well. AWS, Amazon Web Services, has also got its footing, doing quite well in terms of cloud offering. They have a AI offering as well. We'll start to hear about Rufus as perhaps a cousin to Siri, and AI or Amazon is going to be quite competitive in that space. They're also, as I mentioned, making more and more money. The stock's been doing extremely well, but their earnings are rising at a faster rate than the stock price. What that means is the valuation becomes more reasonable. Mentioned earlier that it actually trades at less of a multiple than Costco, and it's falling. So we think this is a fabulous investment. They got their finger in a lot of different pies, and they're used to succeeding. So buy Amazon and hold it long term.
Amazon, number one pick today, or the first of the three top picks, I should say. Number two, NASDAQ, NDAQ. This is not an ETF that tracks the NASDAQ. This is the company that actually runs the NASDAQ exchange.
Exactly. And we've owned this for clients for quite a number of years. It's been quite successful for us. They've made, over the last couple of years, large investments in technology to offer their clients technology-aided drivers, I guess, to succeed. So risk management tools, enhancements, and so on. That's one of the two drivers that's leading to a higher stock price. The other is just good old the listings that they have, and they've done extremely well with that. I've talked earlier in the show about the capital markets business as it relates to banks, but it also relates to NASDAQ. More listings, more IPOs, more capital markets business is great for NASDAQ. So reasonably priced stock with a lot of good things ahead of them.
Okay. And Gordon has already spoken very favorably on JP Morgan Chase. He also likes Morgan Stanley, another Wall Street heavyweight, MS on the New York Stock Exchange. Gordon.
Yeah, it's a little bit of a hybrid. It's not, of course, a pure money center bank, although they do have capital markets business. They reported this morning. I think they're doing reasonably well. I saw that in the pre-market they were down, but they've since gone into the green. As I think they should have, because they beat on revenues, they beat on earnings. Again, capital markets business, very, very strong. But the thing that makes Morgan Stanley a little bit different is that they've got a wealth management unit that is extremely successful. They bought Eaton Vance, they bought E-Trade, and of course they have their legacy Smith Barney business that they many, many years ago, a couple of decades ago, bought from Citi. So reasonably priced stock. You can see the estimated PE there on your screen of 15 times. Great yield, and they've got growth. So this is a company that we think will do well in a portfolio.
Welcome back. Time now for Brianne Gardner's top picks. Number one on this day, Brianne, Visa, ticker symbol V in New York.
Yeah, Visa, largest payment processor in the world. and has a big competitive advantage as it has kind of established a near duopoly in the payment processing market. Many of us, I'm assuming, obviously, including you, Paul, carry at least a couple or one or two credit cards, from each, network, and physically and digital wallets. So we are seeing a societal shift towards more cashless transactions, which we believe that we're still only in the middle of this shift, and Visa is set up to participate in that. It is one of the largest beneficiaries of this change, and it has helped its profit margin. So we saw their April revenues beat estimates. Transactions increased a healthy 31%, and total volume expected to grow by high single digits this year. The stock is up around 11% over the last 12 months. Yes, slightly lagging the index, but has averaged 9% annually over the last 5 years. So we think they have a reliable sales stream, operationals model, and really willingness to adopt a new trend in markets are just some of the reasons why we believe that Visa has returned, will continue to return over the next 12 months. So they have done 400% over the past decade, which is doubling the S&P 500's performance. We have a price target of about $311 per share, which implies potential 15% upside and ranks a full 10 out of 10 for us fundamentally.
Okay. Number 2 on this day, United Health Group, UNH in New York. Brianne.
Yes, United Health, one of the largest private health insurers, providing medical benefits to about 53 million members globally. We have seen a nice spike up in the stock price as of late, and has had this rally recently. And we are up nicely on our position, but we still see more profits ahead. We're looking kind of, again, around that $600 target on the street, showing potentially upside of 20% from here, room to run the last earnings report better than expected. We're seeing buys on the street, as you can see, 26 have a buy, only 2 a hold. Average price target 609 there. United Health could also benefit from, if Trump presidency does play out, we would see their reduced regulation and improved reimbursement schedules under the Medicare Advantage program that would give UNH also a boost. So stocks up around 16% in the last 3 months and has averaged 9% annually for the last 3 years and 16% for the last 5. So for us, ranks a 9 out of 10 fundamentally, and consensus, we continue to hold this stock.
Okay. And number 3 on this day, Lululemon, the Vancouver-based retailer, ticker symbol LULU on the NASDAQ. Brianne.
So for us, this chart's going to look a little different than the last two.
Wow.
We do see this as a deep value play. It is a brand new addition to our portfolio, just picking it up this week. We have traded this stock multiple times over the years and made money on it previously. So we like to actively trade Lulu. And when we see attractive valuations in stocks and companies like this retail sector has been one of the stock market's kind of, even primary pain points in the recent months. But we see, opportunity. And I think that when it comes to Lululemon, there's a bigger picture to consider. First is their quality. Those who buy their products love them, wear them. I wear them regularly when I'm not in my suits and want more of them. So, even men who shop there tend to buy more and more of their pants and shirts. So of the $9.6 billion in revenue they did in 2023, about 80% of that came from America, and China accounting for 10% in sales, and the rest of the world just breaking over $1 billion. So part of the year-to-date figures you see is from really the fact that it rallied hard in Q4 last year from 400 to 500 on their international growth, with really the all-time high basically being the start of 2024. But we believe it's now in an oversold position, and with kind of recessionary fears gone, or in the back burner, have faded. The stock is at a 40% discount to its 10-year average. We have a target of $400 on it, which would imply a 37% return from here. So again, we see this stock as a great stock that we can actively trade, get some profits, and take those off the table. We think it's high quality business, facing challenging macro environment for sure on the home turf, but we do believe the Lululemon story is far from over.
Okay, time now for Barry Schwartz's top picks. Number one on this day, CCL Industries, ticker symbol CCL.B on the TSX. Barry?
We think this company is ripe and ready to go. The company's balance sheet is back into perfect shape for many acquisitions. We noticed that the company has started to pick away at its shares, buying back its stock. We found it curious that CCL didn't buy back stock in the $60 range, but now it's buying back stock in the $71, $72 range. So that must mean there's confidence. We're very close with this company. Ernest talks to them, our head of research, quite often, and trying to get a better sense of what they're thinking about in terms of making acquisitions, starting new projects. We love the capital allocation here. They look, when they launch a new facility to work with their partners, they're looking for 15+% IRR. So the valuation is, the stock hasn't done anything in a long time. Doing well recently, I think it's up 23% year to date. But this used to be one of the best cereal compounders in Canada, top performers, and we think it's going to return to that. The company's guiding long term for better than GDP organic growth. With acquisitions, with some cost control, with share buybacks and dividends, I think you could see double-digit returns for a very long period of time.
Okay, number two today is Domino's Pizza, ticker symbol DPZ on the New York Stock Exchange, and a stock that's plunging today, actually, after the company has pulled its target on new stores. The stock is down about 13%. Barry?
Here's your entry point for what we think. There's a couple things going on today. The company, actually, its top line results were very nice. It's gaining market share from its competitors. Same store sales were quite strong, but it had some missteps with some costs. It said higher labor costs, store opening costs hurt its margins, as well as it's pulling back on some of its guidance for long-term growth internationally, as one of its partners built out in the short term too many stores in Japan and other areas. We think those are noise and short-term issues. Domino's Pizza, if you're going to own it, you want to own it because it provides what we think is a really excellent pizza for the price, for a strapped consumer. It's winning market share, and calculus is 5 to 7% earnings growth, double-digit, what we think, dividend growth. 5%, 7% top-line revenue growth, which we think can lead to double-digit earnings growth over the long term, and I think a pretty good entry point for new buyers here. Okay,
stock down 13% today. Barry says that is an entry point on Domino's Pizza. Amazon is the number three pick today. Barry said he had a e-retailer coming. A lot of people might have guessed it was this one. They guessed correctly. If so, AMZN on the NASDAQ, up 38% over the past 52 weeks.
And they've reported record Prime Day sales. We're seeing a rotation out of some of these Magnificent Seven stocks. Maybe a crowded trade. That's not investing. That's just day-to-day noise. So do you think Amazon is going to be selling more products to your house in the future or less? I think they're going to be selling a lot more. But what we really like about it is we think Amazon has a fixed cost structure, amazing operating leverage. We're seeing an inflection in margins in U.S. retail, in international retail, as well as cloud growth. We think they're a tremendous advertising business. So just so many tailwinds for that it is doing right. And now the valuation has come back to we think is quite an inexpensive level at 21 times EBITDA. So we think Amazon, out of any of the Magnificent Sevens here, is the best position for growth going forward, and at a very reasonable valuation, given what we expect is double-digit earnings growth for many, many years to come.
Time now for top picks from Rick Rule. He's our expert today on resource stocks, of course. Top pick on this day, Rick, Africa Oil, ticker symbol AOI on the TSX.
The attraction here is twofold. One, I believe it's selling at less than half what it is worth. They recently announced that they were consolidating their interest in 3 supergiant fields in Nigeria, taking out their partner for stock. In addition, they have de-risked their exploration by farming down in both Namibia and South Africa, and they have increased their indirect interest in the Great Guyana offshore play I'm sorry, not Guyana, but rather Namibia, in Impact Oil. They have committed to distributing 50% of free cash flow out to shareholders by increasing the dividend, which also already starts at a relatively attractive price of $2.75 per share. The company was started by and continues to be run by affiliates of the Lundin family, with whom I have been investing for many, many years.
You mentioned a pledge to return capital through dividends. Do we see that among the small and micro cap players in the oil and gas sector? It's been a big theme in the large cap sector with the likes, of course, of Canadian Natural Resources, Cenovus, and almost everybody else in the large cap space in Canada pledging to reduce debt, buy back shares, and hike dividends. Are we seeing the same thing from the very small players?
In the American and Canadian market, the answer to that is yes. In the international exploration market, where the upfront capital costs are high, this strategy is very rare. This particular company, Africa Oil, has been successful enough historically, particularly in Nigeria, that they are now able to afford both growth and distribution simultaneously, which is one of the things that makes it so attractive.
Okay, and the analyst community tends to agree with Rick. There are 8 analysts that cover this stock. All of them say buy, with a price target derived from the Bloomberg survey of $3.65 Canadian per share. That's versus the $2.39 where the stock is right now. Okay, number 2 on this day as a top pick, G2 Goldfields. That's ticker symbol GTWO on the TSX Venture Exchange. Rick?
Yeah, I think this is an amalgamation play. They have a wonderful discovery in Guyana adjacent to the discovery made by Reunion Gold, a former top pick of mine on BNN. Reunion was consolidated by G Mining, yet another of my BNN picks. And I believe that G2 ultimately gets consolidated into the same package. Recently, G2 completed a financing with a large South African gold company who is obviously looking at being part of this amalgamation. I think ultimately, and by the way, nothing has been announced, and I think that any amalgamation will take place in the fullness of time. But I believe that by combining G2 with Reunion and GMIN, you end up with a deposit that will be over 10 million ounces and will be certainly in the lowest cost quartile among gold projects worldwide, and also in the best quartile in terms of return on capital employed. So G2 for me is both a discovery stock and a potential amalgamation play. It's run by a very competent team with a lot of experience, both in Canadian capital markets and in South American exploration. Certainly something where a talented team is embarked on an activity that is specifically suited to their skill level.
When you say a consolidation play, do you see this company as a takeover candidate?
I do.
Right.
I do. I think that they would like to continue independently so that they can add as much value as is possible through the drill bit. But this is not a place where 2 different mines should be built on one ore body. It doesn't make any sense at all. Pat Sheridan Jr., who is the CEO, is a really good moneymaker. He built and sold a company before, engaged in exactly the same activity, and I'm highly confident that he'll do it again.
Okay, and top pick number 3 on this day, Kenorland Minerals, ticker symbol KLD, again on the Toronto Venture Exchange. Rick?
A couple nice things about Kenorland. One, I think it is selling at a discount to the value of its royalty and cash holdings, giving you the rest of the company for free. This is an unusually talented management team around generative exploration in Canada. Unlike many talented technical teams, these guys are also commercially very good. This is certainly more of a speculative pick than either G2 or Africa Oil. But exploration speculation has treated me very well over the years, particularly when I get a great exploration team effectively for free, given the value of their royalty and their cash holdings.